Navigating the UK crypto tax landscape in 2026. ISAs, ETNs, and the crypto treasury loophole. Did you know if you gamble in the UK, the proceeds are tax-free? It begs the question, is that designed as an incentive to increase gambling, or what is the actual policy rationale? Essentially, how does tax policy affect investment behavior? In this video, we explore how tax is a major factor of crypto trading in the UK. A large part of successful investing is simply understanding the tax consequences of your actions. In 2014, we started work on policy changes to ensure that the treatment of the trading of Bitcoin was clear for investors. In 2021, the FCA introduced a ban on crypto derivatives for retail. In 2025, the FCA introduced a carve-out from the ban for crypto ETNs. And in April 2026, HMRC requires that crypto ETNs are only accessible in an innovative finance ISA. The end of derivative punts. If you remember, retail CFDs, including perpetual swaps, were banned in the UK back in 2021. Because CFDs are capital assets, gains and losses are subject to capital gains tax, CGT, and even income tax, making them incredibly complicated for professional investors unless held in a tax wrapper. Buying and selling crypto directly also invites CGT and the administrative headache of calculating gains versus losses. Furthermore, you simply cannot put direct crypto into an ISA tax wrapper. The ETN era. Last year, in October 2025, the FCA kept its ban on crypto derivatives but carved out an exception for crypto ETNs, which are basically debt-based ETFs. There are currently 5 providers of ETNs in the UK, offering only Bitcoin or Ethereum. Since October 2025, these crypto ETNs could be held in an ISA. Up until April this year, investors were able to use their stocks and shares ISA to invest in these crypto ETNs, CETNs, tax-free. The massive benefit of the stocks and shares ISA is that after paying income tax, you can put up to £20,000 of your funds into the ISA every year, and everything inside, every gain or dividend, is tax-free. This, with a pension, is the main conduit for building up capital through investing. But the policy of using ISAs to hold CETNs expires in April 2026. From April, the following rules apply to CETNs. Crypto ETNs can now only be bought in an innovative finance ISA, IFISA, which is a highly specialized tax wrapper. This policy change is likely to ensure that Financial Services Compensation Scheme, FSCS protection, does not apply to those investments. Of course, if you previously bought a crypto ETN in your standard ISA, you can keep it there, under accepted grandfathering rules. The real significance here is accessibility. Most brokers do not offer an IFISA wrapper, but they do offer a standard ISA wrapper for investments. The crypto treasury loophole. HMRC has left an interesting loophole open. You can still buy crypto treasury companies via your standard ISA. Counterintuitively, crypto treasury companies are more like a leveraged bet on a crypto ETN, so it could carry far greater volatility. This volatility can be balanced out by the treasury company investing in cash-rich operations companies. The FCA is looking at the concentration risk of crypto treasury companies and may reclassify them accordingly, so most likely the same will seek to combine crypto exposure with investment in high cash flow businesses. In any event, now crypto treasury companies are more accessible than crypto ETNs as a result of this loophole. UK versus US Treasury stocks. Why buy crypto treasury stocks in the UK versus US crypto treasury stocks or crypto stocks like Coinbase if you are a UK taxpayer? If you are a UK resident and you buy on the US stock market, the IRS will charge you a dividend withholding tax and an estate tax if you pass on, even if you bought via an ISA. Buying UK crypto treasury stocks allows you to avoid being taxed by the US. Secondly, buying stocks in growth markets such as the Aquis stock exchange means you can have inheritance tax relief and there is no stamp duty on the trades. Buying stocks in growth markets such as the Aquis stock exchange means you can have inheritance tax relief and there is no stamp duty on the trades. This makes it incredibly easy and tax efficient to buy UK crypto treasury stocks. You can trade in and out of the stocks with no stamp duty and zero tax consequences inside an ISA. I don't suppose it will be long before Revolut supports the Aquis stock exchange. Bypassing the FCA friction. You might have noticed the FCA warnings of, "Don't invest unless you're prepared to lose all the money you invest," when directly trading crypto. Direct trading comes with cool-off periods, product assessments, suitability assessments, and strict classification of investors. Well, none of that applies to crypto treasury products. Nonetheless, the modus of this trading activity is speculate to accumulate. Behaviorally, it is foreseeable that traders will be actively trading in and out of these stocks. Based on the incentives and products available, investors are more likely to treat crypto treasury companies as tax-free speculation within an ISA, and therefore they should only trade what they are prepared to lose. This presentation was for information only. Feel free to reach out to BTC Regs if you have any questions or add comments on the video. Disclaimer: this is not tax, regulatory advice. Do your own due diligence, and please get your own tax advisor.